everyone, welcome to the Tax Roundup for March. We're going to take a look at what's been released and what's important to accountants and advisors across the month. We'll look at the transfer balance cap indexation, what the issues are, and also look at the contribution cap changes. Across to cases, we'll look at the Apted and Slatter cases. Now, these are the ones that came out of the stimulus measures. We'll look at the result of those cases and what they tell us. Also from the ATO this month, there's been a new ruling released on personal services income. Now, this particular ruling is a consolidation of two previous rulings. But first up, the big issue of the month is the guidance released on the profits of professional services firms. Across to Michael to take you through the issues.
One of the big items this month is the ATO releasing some new draft guidelines for those operating professional services firms through a company, trust or partnership structure. Now, we did have some guidelines in this area that were released a few years ago, but they were suspended by the ATO because the ATO was a bit concerned about how those guidelines were actually being used in practice. We've had a bit of a black hole in this area for the last few years, with some people being able to rely on those older guidelines, but really everybody waiting to see what the ATO would come up with next. Well, what the ATO has come up with is a draft practical compliance guideline, which gives us an indication of the direction the ATO is heading in this area. Now, if you were familiar with the older guidelines, then if you pick up a copy of the more recent version, to some extent, they'll look pretty familiar to you. You'll see that there's 3 risk factors that still need to be taken into account. There's some comments around who can rely on the guidelines, but there are some really fundamental differences that are important to be aware of. The first thing is, before you even get to analysing the risk factors, there are 2 gateways that need to be satisfied. The first one basically looks at whether there's commercial rationale for the structure that you have in place and the way that profits are distributed within the group. The second gateway looks at whether your arrangement, your structure, the way you've set up your affairs, has any specific high-risk features. And the ATO gives some examples of the sorts of things it considers to be at the higher risk level, which means that the ATO expects you to then engage with the ATO around that. Now, assuming you can pass those gateways and you are deriving your income or your profits in your practice from a business structure as opposed to personal services, if you're earning income from personal services, you've got another set of issues to deal with, not this issue, but something else. But if the firm is deriving its income from a business structure, so from its goodwill, its employees, its equipment, then we get on to the risk factors. Now, where this ends up being a little bit different is the way that we actually work through these risk factors. The factors themselves, again, will look pretty similar to what you might recall from the old guidelines. But the first thing to note is that with the older guidelines, we had a look at 3 factors, and they were either pass or fail. And you basically just have to pass one of those 3 factors, and that was enough for you to be classified as low risk in this area. These newer guidelines don't operate in quite the same way. The newer guidelines expect that you will work through at least 2 of the 3 factors, and maybe all 3, and it's not a question of pass or fail. It's a question of doing some calculations for each of those factors, and depending on what your calculations are, that will generate a score. And that score will then put you in a certain risk category, which will determine the likelihood that the ATO will undertake some review or audit activities on your affairs. The factors themselves are similar to what we saw before, but as I say, it's not just a simple pass or fail, so there's no black and white cut-off threshold for passing or failing a certain factor. You do a calculation. In most cases, that calculation will generate some sort of number with a percentage attached to it. That will then lead to a certain score. You add the numbers up, it gives you a risk rating. That approach is a bit different. And so where people have been classified as lower risk in the past may find that they're not low risk under this new model or approach. Now, for those people, the ATO has said that they will allow probably some sort of a grace period to adjust from being low risk under the old model to being slightly higher risk under the current model. And so while these guidelines are due to commence from the 1st of July 2021, the ATO is effectively giving or indicating that it will give people up to another couple of years to kind of bring their arrangements in line with the current guidelines if they do want to be classified as lower risk. So at this stage, they are draft guidelines, so just be aware of that they were issued in draft for public comment, consultation. When we see the final guidelines, we'll then have a better idea of exactly what we do need to be doing as we start heading into the next financial year when these guidelines will really become active. But in the meantime, it is probably worthwhile for yourselves and for your clients' benefit to have a look at those guidelines, where you are likely to stand in terms of the way profits of the firm are distributed and what the likely risk level is at the moment. And if you find yourself in a situation where you're not low risk anymore, but you would like to be, at least this is giving you an idea of what might need to be done, for example, over the next few years to move back into that lower risk category. The other thing to note is that the ATO still is on the lookout for a test case, because this is really just the ATO's opinion on what's acceptable or not acceptable. It's a part for A thing, it's grey, there's no black and white answer here. But the ATO would like, or have said that they would like, a test case to run through this so that the courts can put their view on this as well, which would obviously hold a lot more weight than the ATO's opinion. So that's yet to happen. It would be nice if it did at some point so we can kind of see where things really stand from a judicial point of view. But in the meantime, it's the ATO's view, like it or not like it. At least they're kind of telling us where they consider the risk to be, and we can start to move forward from there in terms of if we want to be low risk, what we might need to do to get there.
Now across to Matthew Z on that new ruling on personal services income.
Now, the ATO have been a bit busy lately and released a new draft ruling on personal services income with around 40 different examples. Having said that, the draft ruling does cover quite a lot of old ground, and it's essentially an update of two older public rulings which were released some 20 odd years ago and probably could have used a bit of a refresh anyway. Just to step it back a bit, the PSI rules, or the personal services income rules, generally trigger where you've got an entity that derives income mainly or predominantly from a particular individual's personal efforts or skills. Although the draft ruling does cover a lot of old content, it makes it quite clear now that where you've got multiple people providing their own separate personal services under a single entity, that is not, for example, income from a business structure, assets or employees, you generally need to apply the PSI tests separately to each individual. So for example, in any given income year, you might have one individual that passes at least one of the 4 PSI tests and other individuals that don't. So for the individuals that don't pass, the PSI rules restricts and limits the types of deductions that can be claimed by the entity or the individual against their PSI income. What also happens automatically under the PSI rules is that the value of the individual services are essentially attributed and taxed in that individual's own personal hands. Having said that, passing or not passing the PSI tests might not make much of a practical difference, at least when it comes to profit attribution. This is because the ATO continues to make it quite clear that where you've got an entity that derives PSI, they'll still have some fairly valid concerns around income splitting, and they can still apply the anti-avoidance provisions in Part 4A to those types of situations. I mean, the key point here really is that where you've got an entity that derives income from the personal services and efforts of a particular individual, it's important to keep in mind that there's still an underlying principle that that individual could be taxed on the value of the services they provide. This principle predates the PSI rules, which were introduced some 20 years ago, and can strictly still apply irrespective of whether the statutory PSI tests are met or not. It's just that passing the PSI tests can give you greater flexibility in terms of the types of deductions that you can claim. For example, reasonable payments made to spouses or associates for support services, such as bookkeeping.
Now across to Chloe Ward to look at indexation on the transfer balance cap and the contribution caps.
Just wanting to give you a brief update on matters concerning superannuation and in specifics the indexation to the general transfer balance account that comes into play on the 1st of July this year. Firstly, what we need to look at for our clients is understand what their transfer balance account amount is right now. We then need to have a look at what indexation is going to mean for them based on that amount in the transfer balance account. And lastly, what are the opportunities that we can give to our clients to take advantage of any increases that they may receive. Now, essentially from the 1st of July 2021, we're going to see an increase from $1.6 million to $1.7 million for the general transfer balance account. Those clients that have never had a transfer balance account will have the full $1.7 million available to them. Those that have already reached their $1.6 million limit, unfortunately, will not have an indexation amount applied to them. And those clients that sit somewhere between that $1 and $1.6 million as a credit in their transfer balance account will have an indexed amount somewhere between that $1.6 to $1.7 million cap. Sounds quite complex. How do we figure it all out? There's a few different things that we can do. And we will go through them in a webinar that we're going to be holding on the 28th of April this year to take you through different examples and real life cases so that you can feel confident leading into the end of the financial year that you can help your clients understand what their indexed cap will be. Now, with these increases to the indexation of the transfer balance account, we also have an increase in the contribution limits as well. So concessional contributions will rise to $27,500. The non-concessional contributions will rise from $100,000 to $110,000, and therefore the bring forward provision will also increase from $300,000 to $330,000. Again, all of this seems very complex and quite tricky, and we will take you through all of this in our webinar that we'll be running next month. So hopefully you can join me there and ask any questions that you may have. That's it from me today. Until next time, thanks.
Now, across to Michael on those two cases dealing with the stimulus measures.
There have been two further developments in the stimulus measures area in terms of cash flow boost and the JobKeeper scheme as well, in terms of cases that have been running through the courts. The first one is a bit of an update on the Apted case. You might recall this being mentioned over the last couple of months. This was a scenario where someone had previously run a business, basically retired, but then had started doing a bit of consulting work again. Didn't reactivate their ABN until after they got knocked back for JobKeeper, at which point they then backdated their ABN, which was accepted by the ABR registrar, which they thought would then give them an entitlement to JobKeeper. The ATO disagreed, and it ended up before the tribunal. And what the tribunal originally decided was that the backdated ABN, because the effective date after the backdating, the retrospective effect of that was that it was in place at the relevant date, being the 12th of March. Now, the ATO didn't like that approach, and the ATO appealed that, and it went to full federal court, and it was an expedited hearing to try and get an answer to this pretty quickly. Well, that decision has now been handed down. The ATO ended up being successful on the ABN date point. Basically, what the full federal court said was that, yes, you can backdate your ABN. It is something that can be backdated on a retrospective basis, but in terms of the JobKeeper rules, we need to look at what the situation was at that specific date. As at that specific date, this person did not have an ABN, so therefore did not pass that condition, even though later on they backdated their ABN to before that date. However, the taxpayer ended up still being successful because this particular condition was one where the ATO did actually have some discretion. And the ATO had not exercised that discretion in favour of the taxpayer originally. The tribunal said that they should have. And that this is the sort of situation where the ATO should have exercised their discretion in favour of the taxpayer if they had lost out on the specific ABN date point. Well, the full federal court reviewed that decision and basically said that, yeah, this is a situation where the ATO probably should have exercised their discretion. This was someone who had genuinely restarted a business, had forgotten to reactivate their ABN. That of itself should not have prevented them from accessing government stimulus measures under the JobKeeper scheme. So effectively a win for the taxpayer, but it was on the point around discretion, and the ATO should have exercised discretion given the scenario here. Well, the other development we've seen just recently is a case on the cash flow boost. And this dealt with a set of facts which actually we came across a lot over the last 12 months or so. And again, a similar sort of scenario where we've got certain things that needed to have occurred on or before certain dates. Now, you might recall under the cash flow boost rules, there's a requirement to have an ABN at a certain date. There's also a requirement to either have declared some business income in a tax return that was lodged by 12th of March 2020, or to have made some supplies in relation to your enterprise or business within certain periods, and to have notified the ATO of that by a certain date as well. Now, the trick with that aspect was that the ATO has the discretion whether to accept the late reporting of the supplies being made, but the deadline around making the supplies is fixed, and the ATO does not have the discretion around that. Well, this particular case, the Slattery case, dealt with someone who had restructured their business from a sole trader into a company structure. So a different entity was now carrying on the business in early 2020. That business made supplies, the company made supplies through that business before 12th of March 2020, but they were reporting on a quarterly basis. So the company had quarterly tax periods, which meant that in order to qualify for the cash flow boost, it would have needed to have made its first supply on or before the 31st of December 2019. Well, the business didn't get restructured until after that date. So it wasn't really possible for any supplies to have been made by the time they needed to have been made. Now, again, the key point here is the ATO does have the discretion to extend the deadline for reporting those supplies. The ATO does not have the discretion around the deadline for when those supplies need to have actually been made. And in this case, the tribunal said the supplies were not made by the relevant deadline. It's not something the ATO could kind of just exercise discretion around. The legislation does not give the ATO discretion around this. As odd as this outcome is and as unfair as it might seem, in a situation like this, it's just a feature of the legislation and not something that anyone can really do about it, except for changing the legislation, which is probably not going to happen anymore. So a couple of cases where we've seen developments in cash flow boost, JobKeeper, dealing with, in some cases, some slightly unusual facts, in other cases, dealing with the sort of facts that we were seeing over and over again over the last year or so. And that importance that if you are going to challenge the ATO's decision around cash flow boost or JobKeeper, really need to go back to the rules. Is it an area where the ATO had some discretion over? In which case you can ask that discretion. You can tell your story and why you think it's appropriate for the ATO to exercise that discretion. But be careful what you're actually dealing with, because in some cases, the ATO simply doesn't have discretion. And if you fail one of those conditions, you're probably wasting your time asking the ATO to look at it in more detail. So just make sure you're aware of exactly what is the issue at point and whether the ATO has any power to do anything about it or not.
And that's the tax roundup for this month. If you're not a member of Knowledge Shoppers yet and you want to stay on top of change and make sure your practice is running efficiently, then give the team a call on 1800 800 232. We'd love to show you what we can offer.